I'm Daniel.
And I'm Mira.
We are jumping right into a really deep dive today. We're looking at the weekend's crucial market developments to help you understand the baseline you're operating against for the week ahead.
Right, because, so much happened over the weekend, and you really need that context to navigate Monday morning.
Exactly. So if you're prepping your portfolio, consider this your roadmap. But before we dive into our first session, I just need to clearly state that this show is for market context and discussion only. It is absolutely not personal investment advice or an investment recommendation.
Yeah, we're just here to break down the data. What you do with it is up to you.
For sure. So let's open up session 1, market movement recap. The big question we really need to answer here is what exactly drove the sharp tech sell-off and the massive energy breakout last week?
Well, to figure out the why, we really need to start with the raw data to ground you in what actually happened. So wrapping up Friday, July 17th, we saw the S&P 500 retreat from its Wednesday peak. It fell about 1.55%, closing at 7,457.69.
And the NASDAQ took a much heavier hit, right?
Yeah, it did. It dropped 2.90% to close at 25,520.24.
Which is a pretty big slide. And underneath those numbers, the sector divergence was just massive.
Oh, completely. Information technology fell 3.6%, while energy actually gained 4.9%.
Right, and that energy surge is entirely tied to the commodities market. We saw this headline-grabbing surge in crude oil.
Yeah, WTI crude surged 14.47% to close at $81.74 a barrel.
Wow.
And Brent climbed 15.88% to $88.08.
Which, naturally brought a huge wave of risk-off sentiment. The VIX spiked from a midweek low to settle at 18.7 this up.
Exactly. But here's the really interesting part about the credit and rates context. Despite that equity drop, the bond market barely flinched.
Wait, really? With that kind of volatility?
Yeah. High-yield corporate debt, the HYG ETF, was virtually flat. It hovered right around 79.65. And the 10-year Treasury yield ended basically unchanged at 4.554%.
Okay, so that gives us what we call credit stability signaling a non-systemic duration shock.
Right, which is just a fancy way of saying the bond market isn't worried about widespread corporate bankruptcies. It looks much more like a valuation and sector rotation rather than a real solvency event.
But, I kind of have to push back on the panic here.
How so?
Well, we had bank earnings earlier in the week, and they showed really resilient consumer spending. JP Morgan had 10% card volume growth. So is this tech sell-off just a mistimed reaction?
That's a fair question.
Or is the market just taking profits on really expensive growth stocks? Because the consumer doesn't seem to be buckling yet.
That's true, but you have to remember the market is looking forward. The equity markets aggressively repriced the risk of future inflation because of that oil spike, even while credit remained totally stable.
Yeah, that makes sense. Equities repriced the risk, credit held firm. All right, let's take a quick break, because things got much, much more complicated over the weekend.
And we are back with session 2, weekend news and macro implications. We're asking, how do the escalating Middle East conflict and tech sector headwinds reshape our baseline for Monday morning?
Right. And to transition from Friday's radar, we were already bracing for Middle East headlines. We also had the China loan prime rate decision scheduled for Sunday at 9:15 p.m. Eastern Time and AMD earnings Monday morning.
Yeah, our watch next list was already packed.
Yeah.
But the geopolitical escalation really just took over. We saw a total collapse of the Hormuz maritime truce.
Just completely fell apart. Let's lay out the timeline for everyone. On Thursday, July 16th, U.S. strikes targeted Iranian bridges and radar in Loristan.
And Iran retaliated heavily. They launched widespread drone and missile attacks on U.S. deployments in Kuwait, Qatar, and Bahrain.
By Friday, July 17th, the U.S. had resumed its port blockade. But what really matters for the markets here are the direct hits to physical infrastructure.
Absolutely. The Iranian strikes hit a Kuwait Petroleum Corporation oil facility.
Which is huge.
Yeah, and they caused a fire at Kuwait's primary power and water desalination plants. Jordan also had to intercept missiles, which prompted threat alerts at the Aqaba seaport.
Okay, but let me jump in here. When we hear about these events, it's really easy to frame them like an unpredictable natural disaster, but I want to challenge that.
Right, through a game theory lens.
Exactly. Geopolitical escalation as game theory brinkmanship. Are these calculated strikes on desalination plants and blockades actually a highly calibrated leverage play? Like, instead of just chaotic warfare, they know exactly what pressure points to hit.
I mean, it's definitely calibrated leverage. But for the macro inflation context, the intent almost doesn't matter because the economic impact is immediate. It causes a massive oil shock.
Which ties the Fed's hands. We heard speeches over the weekend from Fed Vice Chair Jefferson and Hammack, right?
Yeah, and they pointed out that their preferred PCE nowcast shows core inflation running at 3.3%.
And this is where we see central bank demand destruction against supply inflation. They are trying to cool down demand, but they're getting hit with broad-based price pressures from energy that they just can't control.
Plus the massive energy demands from the AI data center build-out. So it's a double hit.
Yeah, and speaking of tech and AI headwinds, we also got a massive cybersecurity shock. On Thursday, July 16th at 9:04 p.m. Eastern Time, the White House announced a massive Chinese hack.
Yeah, accessing 220 million U.S. voter records.
Yeah.
And keeping strictly to the market implications here, that kind of instability really rattles tech sentiment.
It does. It escalated right into a private market shock. SpaceX's valuation absolutely slumped over the weekend. It erased over $1 trillion from its post-IPO peak.
Which is just wild. It perfectly illustrates AI CapEx as a self-defeating valuation loop.
Yeah.
Companies are spending so much on infrastructure that it's crushing their valuations before the profits even arrive.
But, you know, we did get one bright spot for semiconductor resilience amidst all this tech selling.
Right, the TSMC announcement.
Yeah. Posted by Trump on Truth Social on Friday at 3:32 p.m. Eastern Time. TSMC is committing an additional $100 billion to their Arizona fabs.
Which brings their total to $265 billion.
Yeah.
So they're aggressively building out physical infrastructure in the U.S.
So to wrap up session 2, our macro baseline is completely dominated by an active energy supply shock and some extreme valuation friction in tech. Let's signal a short break before we look at the week ahead. All right, welcome back to Session 3, What to Watch. The question for this session is, what are the critical events that will dictate market direction over the next 5 days?
Well, we've got exactly 5 key catalysts on the timeline that you need to watch.
Okay, lay it out for us.
First, running from July 20th to the 24th, we have the ongoing U.S.-Iran conflict and the Strait of Hormuz shipping developments. That is the primary risk for crude oil, the U.S. dollar, and equities.
Yeah, that's going to be casting a shadow over everything else. What's number 2?
Number 2 is on Wednesday, July 22nd at 10:30 a.m. Eastern Time. It's the EIA Weekly Petroleum Status Report. We really need to see the refinery runs and implied demand, especially following the weekend's oil price spike.
Super critical. And number 3?
Also on Wednesday, July 22nd, but after the market close, Alphabet and Tesla report their Q2 earnings. This is basically the ultimate test for AI monetization and broader NASDAQ risk sentiment.
Definitely. Okay, what about Thursday?
Thursday, July 23rd at 8:30 a.m. Eastern Time, we get initial jobless claims. And alongside that, the 10-year TPS auction, which is going to help gauge real yield demand.
Got it. And the final catalyst.
Friday, July 24th at 9:45 a.m. Eastern Time. The S&P Global Flash July PMIs followed right at 10 a.m. Eastern Time by June new home sales.
Okay, that is a heavy week. You know, I was looking at the weekend research, and I just have to say we went into this weekend hoping for some quiet summer relaxation.
Yeah, we really did.
But instead, we got a crash course in Middle Eastern shipping lanes and a reminder that to the moon is no longer SpaceX's trading direction.
Not anymore, that's for sure.
So as you set your alarm for Monday, just remember, if the market opens in the red, you can always hedge your emotions by telling yourself it's just a very dramatic rotation into physical assets. May your coffee be stronger than the VIX tomorrow?
I think we're all going to need extra